Live from London, this is Bloomberg Daybreak Europe. I'm Vonnie Quinn with your top stories. Oil easing after its highest close in more than 3.5 years as Israel says it won't attack Iranian energy facilities. And President Trump says he's, quote, not putting troops anywhere. Stocks fluctuate and bonds slide as traders weigh the potential economic impact of a protracted conflict in the Middle East. Plus, the European Union deadlocked over a €90 billion loan for Ukraine as the Hungarian Prime Minister refuses to budge. So let's take a look at these markets, specifically the oil market, because we did come off our highs, but we're still very close to 107 on Brent. Now, granted, WTI is right back down to 93 and change, but we're still very elevated from where we were. And we have to see if all these promises play out as they have been iterated, right? Clearly, central banks are worried. It's a very different regime today than it was just 24 hours ago after the BOE and the ECB and the BOJ, frankly, turned relatively hawkish. If you look at the dollar index, we're seeing that trade come back on ever so slightly, up about 0.2%. And let's take a look at some other asset classes, because obviously treasuries aren't trading. It's a holiday in Japan. We saw that massive move, particularly in front ends yesterday, and gilts in particular, a 40 basis point move. Right now we have stocks pointed to gains, but those Nasdaq 100 futures are coming right off their highs of the day. And the yen did strengthen after the BOJ comments yesterday and those hawkish comments, frankly, from the BOJ governor, but it's still very close to 159. Your risk events then for today. At 7 a.m. UK time, we get UK public sector finances. It's also triple witching, so expect a lot of volume, particularly in the last hour of the US session. And then we have the ECB's Nagal speaking, and that's at 5:30 p.m. UK time. Oil has pulled back from its highest close since July of 2022 after Israel said there would be no more attacks on Iranian energy facilities. Let's get an update on the market reaction from Winnie Su in Hong Kong. What are we seeing today, Winnie?
Yeah, morning, Vonnie. As you mentioned, there is a bit of a relief when it comes to the oil and gas space after those comments from the U.S. and Israel, and also Scott Bessent mentioning how the U.S. is looking to unsanction some of these Iranian oil. So you can see here Brent crude up down more than 1.6%. But remember, we are coming off as high as $120 per barrel just yesterday, and so far since the war began, we have actually traded up about 50% already. Now, also to watch is that gap between Brent and WTI remains very wide, and that comes as how the Strait of Hormuz remains shut, as well as investors expecting that any effort from the U.S. is likely going to help WTI more. That's why you are seeing, in fact, WTI pulling back more than Brent today. Flip the board and take a look at how that's impacting the broader Asia market. Stocks here in Asia fluctuating a bit, and now actually in the downside a little bit more as you take a look at how MXAP down about 0.2%. But when it comes to this week's performance, we are actually slightly still in the green, but that's coming after 2 weeks of declines already. And remember, since the war started, we have already fallen about 8% in Asia, underperforming what we see in the S&P 500, still that reliance on oil imports. So we will be very closely watching further developments over the weekend. Back to you, Vonnie.
Yeah, could be a volatile day. Winnie, thank you so much. Winnie Su in Hong Kong. Israel says it will no longer target Iranian energy infrastructure after sparking retaliatory strikes and a rebuke from President Trump. Prime Minister Netanyahu also pledged the help of Israeli forces to reopen the Strait of Hormuz.
The death cult in Iran is trying to blackmail the world by closing a key international maritime route, the Straits of Hormuz. It won't work. Israel is helping in its own way, and intel and other means, the American effort to open the Straits of Hormuz, rather.
Let's bring in Bloomberg Horizons anchor Jumana Bersetchi. So, Jumana, despite Israel's apparent promise, the IDF does seem to be stepping up strikes on other targets. Can you give us the latest?
Well, I think it's important to note here, Vani, that President Trump has been attempting to distance himself from those Israeli airstrikes conducted on the Iranian natural gas fields. And yesterday, notable as well, that during that press conference, the Israeli Prime Minister Benjamin Netanyahu did say that Israel acted alone, and then he said that they will no longer conduct attacks on energy infrastructure sites at the request of President Trump. The Iranian Foreign Minister Abbas Araghchi did put up a post saying that if they were to get attacked again, then they would show no restraint, zero restraint in their response, and that the response that we saw yesterday showcased limited firepower. So this is a warning that has come through from Iran. That being said, I should just say in the last 12 hours, we have continued to see strikes and counterstrikes. Over the course of the evening, the IDF announced that they had launched a massive wave of airstrikes over Tehran, targeting over more than 100 different sites and even infrastructure sites within Iran. So they continue to go quite heavily with these military operations. And in retaliation, Iran has not let up overnight either. We've heard about interceptions go through in Kuwait, in Saudi Arabia, once again. Also over here in Dubai, successful interceptions in the early hours of the morning. And once again, we are hearing about a fire in a Bahraini warehouse. So it's not as though the response intensity has actually diminished, but maybe at least now there is an understanding that energy infrastructure, at least upstream energy infrastructure, is a red line for all parties involved. Yet to be seen, though, how this is all going to play out, because some of the ramifications from yesterday's damage could have months, even years-long consequences, as we found out from Qatar Energy overnight.
Yeah, absolutely. And then also, Jumana, Netanyahu made some comments about the need for a ground component in Iran.
Yeah, so in that same conference, the Israeli Prime Minister talked about them working on degrading Iran's missile capabilities, their naval capabilities, their defensive capabilities. But then he also said that airstrikes alone are not going to lead to leadership change, and that maybe, he said, some ground participation could be necessary, hinting that, at some point in the future has not ruled out the possibility of ground troop involvement, but that you would need to see the Iranian broader public participate in an uprising. Now, I should just say that this is contrasting with what President Trump said also. He was at a press conference yesterday alongside the Japanese Prime Minister, and he was asked about whether the U.S. would commit troops on the ground. He ruled out that possibility. He said that it is not on the table right now from the U.S.'s perspective, even though there had been many reports over the past week suggesting that they are mobilizing a group of thousands of Marines towards the strait to help with the reopening of the strait. And also just interesting, too, that some comments have come through from Tulsi Gabbard. She's the main U.S. spy chief, so to speak. And she actually said that there may be divergent objectives between what the U.S. are trying to achieve and what Israel are trying to achieve. She said mainly U.S. objectives are military in nature, whereas Israel have one further objective, and that is a change of leadership.
All right, we'll keep monitoring, obviously. Bloomberg's Jumana Bersachi in Dubai. Well, we've been seeing fresh volatility in bond markets as investors rush to bet on higher interest rates, with the surge in oil prices threatening to reignite inflation. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. So, Garfield, temperatures do seem to be coming down, at least in the political and geopolitical spheres. However, the Treasury market has been so much more sensitive to this than really any other market beyond oil. Should we expect, when we start trading again in about 50 minutes' time, that we'll see some calm reflected there too?
Well, there might well be some calm. In fact, there was already calm that spread across at least the long end of the Treasuries market towards the end of the US day yesterday, when we had the optimism that comments from Israel and the US were signaling that we were going to see some decrease in the intensity of fighting and even potentially moves towards some sort of a resolution. That brought down the temperature a bit when it came to the bond market, and concerns in particular that inflation expectations might really get going. The pain point for bonds is now at the short end. Short end yields are still up noticeably this week, whereas 10-year yields, both in the US and elsewhere, are actually little changed or even slightly lower this week. So what we're looking at is effectively a bear flattening move, which fits with an environment where you have central banks turning suddenly hawkish or suddenly more hawkish, as the case may be. So with the potential that supply shocks are still going to work their way through the economy, whatever might happen when it comes to the development of the war itself, central banks are going to go on being, at least for the short term, vigilant about inflation. That will keep a floor on short-end yields or even send them higher. So any gains for longer-end bonds, declines in long-end yields, as optimism grows that oil prices are going to be coming down and the inflation angle will be improving, that's not going to stop that. You've got that chart up there. Thank you very much. Yeah, we're looking at the biggest weekly flattening for the 2s10s in the US since February last year. And that trend has the potential to have plenty of legs.
Yeah, we're at 45 basis points now, Garfield. All right, we will continue to monitor the Treasury market and, of course, the oil market, on which it depends right now. Garfield Reynolds leads our Markets Live Asia coverage. European Union leaders have been unable to break a deadlock over a €90 billion loan to Ukraine. The Hungarian Prime Minister Viktor Orbán is refusing to budge until he regains access to Russian oil, leaving European leaders frustrated.
Let me turn to the €90 billion support loan for Ukraine. A decision was taken by the European Council in December, and there was one condition. The condition that 3 countries would not participate in the loan. That condition has been fulfilled. So let us be clear about where we stand. The loan remains blocked because one leader is not honouring his word. But let me reiterate what I already said in Kyiv. We will deliver one way or the other.
Let's talk now to Bloomberg's chief Europe correspondent, Oliver Crook. So, Ollie, how long can Ukraine fight without any new funding?
It's really, Ivani, a matter of weeks here. We're talking about the end of April when the funding situation in Ukraine becomes very, very dire. Maybe that can stretch into the month of May, but it really puts urgency on the necessity of getting this €90 billion loan to the Ukrainians from the European perspective, which, of course, will fund the budget and the military efforts to 2/3, not just for this year, but for the year to come. And, of course, that has been made very, very difficult by Viktor Orbán, the Prime Minister of Hungary, who says here from the meetings in Brussels Situation Report, it was a tough debate, but we stood our ground. We have the right to say no to the Ukrainian war loan as long as Zelensky does not lift the blockade, the oil blockade. They will not receive any money from Brussels. No oil equals no money. And at issue here is a damaged pipeline that flows through Ukraine, brings Russian crude oil to the Hungarians. Remember, they are an exception to sort of the rules in the EU against Russian fossil fuels. And that is destroyed, of course, by the Russians. And the Ukrainians say they're trying to fix this pipeline. But this is at the heart of the debate here. Now, we should say that this was an issue, this €90 billion loan that was settled back in December. And as a consequence, with Viktor Orbán pulling out of this, it has upset very greatly all the other European leaders, not just on the principle of not supporting Ukraine, but on the fact that it reduces the credibility of the European Union. Have a listen to the European Council President, Antonio Costa, who's generally a fairly sort of jovial and soft-spoken figure.
The leaders take the floor to clearly condemn the attitude from Viktor Orbán, to remember that once a deal is a deal, and all the leaders need to honor their word. And nobody can blackmail the European Council. Nobody can blackmail the European Union institutions. And we need to deliver on this.
I think the word of the summit was blackmail. Viktor Orbán used it there. You heard it from Antonio Costa. We heard from Chancellor Merz from Germany saying this is a gross violation of loyalty and the damages the reputation of the EU as a whole. I should say, though, Vani, this picture would not be whole without the political backdrop here. There is an election in Hungary on April the 12th. Viktor Orbán is behind by double-digit percentage points. If he acts strong on Ukraine, he's also hoping that it's going to help him domestically. And as for the other 26 members sitting around that table, many of them are hoping that that is the last time Viktor Orbán will be sitting there, which is a distinct possibility.
All right, Oliver, thank you so much. That's Bloomberg's Oliver Crook, our chief Europe correspondent. Just want to bring you some lines now from the Latvian central bank governor, also governing council member on the ECB, Martin Kazaks. He's saying we know inflation will go up and the economy will slow. Energy shock, though, is not as big as what we saw back in 2022, and the ECB will take stock in April. So that is the current stance from Martin Kazaks, ECB Governing Council member, Latvia Central Bank Governor. The ECB will take stock in April. The energy shock is not as big as what we saw in 2022, though inflation will go up and the economy will slow. Coming up, an awkward moment in the Oval Office as Trump invokes Pearl Harbor in front of the Japanese Prime Minister. That's next. This is Bloomberg.
When we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? You know, he's asking me, no, you believe in surprise, I think much more so than us.
President Trump apparently joking about Pearl Harbor during his meeting with the Japanese Prime Minister at the White House. That awkward moment perhaps underscoring the tensions that are simmering over President Trump's push for Japanese assistance in reopening the Strait of Hormuz. Sidestepping pressure from President Trump, Takaichi said she reminded him about the legal restrictions on Japanese military deployment.
And speaking of the situation in Iran, Iran's development of nuclear weapons must never be allowed. And that is why we, Japan, have been urging them and also reaching out to other partners in the world. In addition, Japan condemns Iran's actions such as attacking the neighboring region and also the de facto or effective closure of the Strait of Hormuz.
Let's bring in Bloomberg's North Asia Economy and Government Managing Editor, Jenny Marsh. Jenny, the visit was bound to be fraud, but what were your key takeaways?
I think the main takeaway is that Takaichi has enough sort of political capital with Trump to sort of ride this out. You know, going into the trip, she herself had said this is going to be an extremely difficult visit because of Trump's request that Japan send warships into the Strait of Hormuz. You know, and she managed to sort of glide through that, and really her personal relationship with him here was sort of on show. You know, she came into power with very little foreign policy experience, and she's shown that actually she's a bit of a natural on the world stage. She was clearly visibly shocked by his comment on Pearl Harbor, and you saw her sort of recoil a bit, but, you know, she kept on smiling politely. She didn't respond to that, and she just sort of, you know, kept to her strategy, which was to think about the trade and the investment deals they could do, and to flatter Trump as well. You know, she's learned that the way to Trump's heart is sort of through his ego.
Yeah, as many leaders have. Now, the visit was also supposed to be an opportunity to strengthen economic ties. The two leaders announcing a nuclear power project. Tell us a little more.
That's right. So this is all part of the big sort of $550 billion investment fund established last year as part of their trade truce. So we saw there was the nuclear reactors. This came along with some natural gas generation facilities they've agreed on. And Japan also said that it would step up production of the interceptor missiles that it makes and supplies the US with, which are now obviously in very high demand due to the war in Iran. So Japan sort of showing there that it can help the US in sort of diversifying its energy supplies, but also as sort of, it can't send warships, but it can be helpful as a military partner in other ways, specifically sort of supplying some of this military hardware that the US needs right now.
Jenny, thank you so much for all the context. Much appreciated. That is Bloomberg's Jenny Marsh. Coming up, the U.S. Defense Secretary says it takes money to kill bad guys as the Pentagon seeks $200 billion for the war in Iran. More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Dubai has long sold itself as a safe haven in the Middle East, but Iran's unprecedented strikes on U.S. partners across the region are putting that reputation under pressure. Bloomberg Originals has been looking at how Dubai's model of stability is being challenged.
These attacks were unprecedented. We could not have imagined this scenario actually playing out.
Most airports and airlines in the region are affected.
Drone has hit a residential tower overnight in Dubai. It sparked a fire and residents were forced to evacuate the building.
This conflict has come to the doorstep of a territory that many perceived to be one of the world's top safe haven territories.
That perception was by design and helped attract both money and talent. The strikes threaten more than lives and infrastructure. They're testing Dubai's model of stability and the image it wants to project.
Iran's formerly supreme leader, Ayatollah Khamenei, is dead.
We've already won in many ways, but we haven't won enough.
Thousands of deaths across the region have been reported in the war begun by the US and Israel. Iran's wave of retaliatory strikes targeted US allies, prompting the UAE to prioritize safety above all else.
Iranian strikes have hit airports, military bases, even data centers.
The UAE has seemingly defied what many assumed would be an existential threat. It's navigated peril before, but with war on its doorstep, can it do it again?
Subscribers can watch that documentary in full on the terminal and at Bloomberg.com. You can also find more from Bloomberg Originals on their YouTube channel. Now to some other top stories we're following this morning. Bloomberg understands that the Pentagon has asked Congress for an extra $200 billion to fund the war in Iran. Sources say the request has been sent to the White House for review, and President Trump is yet to sign it off. When asked about the $200 billion figure, the U.S. Defense Secretary didn't deny it, but did say the number could move.
As far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys. So we're going back to Congress and our folks there to ensure that we're properly funded for what's been done, for what we may have to do in the future.
Sources have told Bloomberg that President Trump and top Justice Department officials support a new bid to investigate Fed Chair Jerome Powell. Last week, a judge rejected subpoenas issued to the central bank, which prompted U.S. Attorney Jeanine Pirro to say she would appeal the decision. The investigation is related to the Fed's $2.5 billion renovation of its headquarters and testimony Powell gave to the Senate. Staley's wife has filed for divorce from the former Barclays chief executive, who was banned from the UK financial industry over his relationship with Jeffrey Epstein. Deborah Staley's divorce filing comes after Jess Staley publicly testified about being unfaithful to her years earlier with one of Epstein's staffers. A lawyer who's recently represented Staley didn't respond to requests for comment. Coming up, the European Central Bank keeps rates on hold, but could they hike as soon as their next meeting? We'll discuss with Swiss Re chief economist Charlotte Muller next. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Bonnie Quinn with your top stories. Oil easing after its highest close in more than 3.5 years as Israel says it won't attack Iranian energy facilities. And President Trump says he's, quote, not putting troops anywhere. Stocks fluctuate and bonds slide as traders weigh the potential economic impact of a protracted conflict in the Middle East. Plus, the European Union deadlocked over a €90 billion loan for Ukraine as the Hungarian Prime Minister refuses to budge. So let's take a look at those commodities then, because we are seeing a little bit of easing in this market. Brent crude, though, still above $107 a barrel. It's most obvious in WTI, where we're at about $94 a barrel. Haven't come off hugely, but at the height yesterday, we were at around 116, 118 on Brent. So there is, a $10 coming out of that market there. But at that being said, there are still attacks going on, and we have to see how the situation develops. We are seeing a little bit into the US dollar. We saw some strengthening in the yen after some of these central banks turned quite hawkish. The ECB is now seeing an average inflation data figure of 6.5% in the worst case scenario for this year. So that'll tell you just how much central banks are keeping an eye on the situation. In terms of futures, we were seeing a potential for a higher open. That's come off the boil a little bit. Europe looks to be opening higher, the US not so much. Gold, as you can see, has turned around. It was on track for its worst week in 6 weeks, and it's now higher again. Copper higher again, and silver really coming off the boil, down about 0.8%. Time now for your front page news, all dominated by the Middle East. The Financial Times leads on Israeli Prime Minister Netanyahu claiming that US-Israel strikes have destroyed Iran's ability to enrich uranium. The Israeli Prime Minister is suggesting that war will end, quote, a lot faster than people think. The Wall Street Journal splashes on US warplanes and helicopters kicking off the battle to reopen the Strait of Hormuz. Efforts taking on a new urgency to reopen the key waterway as oil prices soar. And finally, Les Echos also leading on the Iran conflict, saying US President Trump is shifting the blame to Israel as the conflict escalates. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayBGo. All right, I want to give you some lines now from ECB Governing Council members which have been crossing the terminal. We've heard from at least 3 this morning, and the latest is Joachim Nagal. He's saying we would need an April hike if the price outlook sours. This is Joachim Nagal speaking in the last few minutes. He's saying the 2022 experiences will play an important role, and the development of the conflict will have a major price implication. We've heard this from several ECB Governing Council members just in the last hour. Martin Kazaks of Latvia also saying they're keeping a huge eye on the escalation and the supply shock. Once again, Joachim Nagal saying that there would need to be an April hike if the price outlook sours. All right, well, we heard something similar from Christine Lagarde, if maybe just a little bit more guarded at yesterday's news conference. Certainly all eyes on the oil price. Take a listen to what she had to say.
The risks to the inflation outlook are tilted to the upside, especially in the near term. A prolonged war in the Middle East could lead to a larger and longer-lasting upward shift in energy prices than currently expected, raising euro area inflation further.
We're joined now by Charlotte Muller, Chief Europe Economist at Swiss Re. How serious is the situation, Charlotte, now that we have, Joachim Nagal actually coming out and saying, look, we will see an April hike if this really does feed into inflation?
Good morning. So our baseline going into this year was that we weren't expecting any hikes from the ECB. However, now naturally this conflict does raise risks for ECB rate hikes. In terms of the sequencing, it all is very conditional, and it depends really on the severity and also duration of the energy shock. But I think what they're also looking for are several other signposts. It's also, number one, inflation expectations. So how quickly do you potentially also see the resetting of price expectations? Number two, it's also looking at labor markets. For example, the bargaining power of labor, could that lead to second round effects? It's also looking at margin pricing power, and also the fiscal policy response too is, I think, key, because that will also affect, maybe distort or keep inflation expectations not as high in the near term if you have fiscal intervention, but in the longer term it could add to inflation pressures. So for the ECB, I think the April meeting is live, but it's still too early to say if it's a definite case that they would be hiking. But if they wait until June, there is a risk they're a bit too late, and they don't want to repeat the mistakes potentially from 2022.
Yeah, although we did hear from Martin Kazaks today saying that it wasn't quite as bad as 2022. It's not the same type of situation, although lessons, have been learned. Curious, Charlotte, if the damage has already been done. So we are seeing what could be a de-escalation on both sides. We'll have to see if that actually plays out. But if we were to see oil prices come down now, would that take April off the table as a necessity?
So that could take off potentially April, but I don't think that will take away the pricing of potential rate hikes for later this year. So yes, on one hand, we are in a different situation to 2022 where we don't have the reopening dynamics post-COVID lockdowns that could amplify inflation risks, right? In 2022, we had much more tight labor markets, much more stimulus in the system. So that could potentially, that was amplifying inflation risks back in 2022. That said, there will be a geopolitical risk premium in energy prices. They will be trading higher. And regardless, even if you do have energy prices a bit lower, inflation is going to be printing much higher for March. We expect potentially 2.5%, and it will lift full-year inflation expectations.
Yeah, and the expectations are key. Charlotte, right now the ECB, in a worst-case scenario, sees inflation peaking in the first quarter of next year at 6.3%. I mean, the ECB can't let that happen, can it?
No, and that also speaks for them wanting to probably act early and not wait too late. So I think, therefore, definitely the expectations of rate hikes for the rest of this year, that will be staying in markets. I think if I look there at the severe cases that the ECB published yesterday, their inflation assumption looks reasonable. Where I would say actually maybe where I would disagree is on their growth assumption. So they had only 0.4% for GDP growth in their adverse scenario. And I think you could have actually growth much more severe because at higher also oil prices, you have increasing non-linear effects on economic activity, and then the economic hit could be much greater too. So then really a stagflation environment.
And they're penciling in, oil above $80, but not that far above $80 as an average for this year. So, oil would have to come down a lot to meet that average. So are you particularly worried about demand destruction then, more so even than inflation potentially?
I think you need to have oil prices even much more elevated for much more longer to really see that demand destruction. So as a result, I would say we're still seeing a much more asymmetric shock with a greater hit to inflation, at least initially, than to growth or demand, at least in the very near term. So at the moment, the main concern for the ECB is still inflation, and that's why we think rate hikes are going to stay still on the table for this year.
Charlotte, what economies could weather this best in Europe?
So it really depends on the energy mix. One example could be France, because they're also much more diversified in their energy mix, for example, with more nuclear. The issue at the moment is energy prices, they're global, right? So even if a lot of, say, also the LNG goes to Asia, Europe will be competing with Asia to get that LNG gas. So then it's about looking at potential other sources of energy, and there I think France is better mixed or better suited than, say, other countries that are more dependent on LNG or traditional fossil fuels.
Charlotte, thank you so much for joining us today. Really appreciate your time. That is Charlotte Muller, European Chief Economist at Swiss Re. The Swiss National Bank has restated its heightened readiness to sell the franc as officials held back again from the more drastic step of cutting borrowing costs into negative territory. Policymakers left their benchmark at zero for the third consecutive meeting. President Martin Schlegel told us the SNB is using a range of indicators to judge whether the franc has strengthened too far.
This is something that we look at on a holistic approach. So we look at the Swiss franc, all the exchange rates, basically, and also then on monetary conditions, which consist of interest rate environment and the exchange rates. And based on this, we say if the monetary conditions are appropriate for Switzerland or not.
Coming up, the Bank of England holds rates but warns of possible hikes to come. We'll discuss the outlook next. This is Bloomberg. President Trump and the conflict in the Middle East are now determining monetary policy in the United Kingdom. That's effectively the assessment of the Bank of England, which warned that Britons will be paying the price. Governor Andrew Bailey said the bank's latest decision to hold interest rates at 3.75% was because of exceptional market conditions.
This is a very volatile situation. I think by the next time we meet, which will be, our next decision is at the end of April, a lot will have happened, and I can't predict what. I can't possibly. None of us can predict what it will be. But it is a very volatile situation. So I would caution, really, against getting ahead of that position, which is we held this time.
Let's bring in Tanika Fricke, head of UK equity research at W1M. Tanika, how surprised were you yesterday by just how hawkish the governor sounded and that 40 basis point move in the two-year gilt?
Yes, no, clearly geopolitics had taken over the Bank of England decision-making, but expectations were still for maybe 7-2 kind of split, but it was all 9-0 for hold. But yes, inflation is a big risk, and whilst sort of UK households will be protected through a price cap on their electricity bills until July, clearly gas futures are pointing to a much higher price to be paid from July if things don't change. So very volatile and uncertain.
You actually point out that the contracts that feed into Ofgem's price cap for July to September are actually 35 to 40% higher. Could that come down, and could it come down speedily?
Yes. So volatility is the name of the game. So it's really about the European gas price that's so important. And what we saw yesterday when we had the bombing or the attacks on the Qatar energy facilities, that initially European gas price spiked up 25%. In the end, it closed down 10%. So anything can happen, but it needs to happen sooner than later, because we will hear from Ofgem the end of May about what was going to happen in July.
How can monetary policy help if that's the situation, if it's energy prices? Will interest rate hikes, and potentially even 3 of them this year, will that not just cripple the economy?
They won't help, because clearly this is a global price issue where commodity prices just feed into the whole system, and what happens to interest rate can't slow that down. But still, monetary committees around the world have this inflation target, and they need to act on that. That's their mandate.
Tanika, is there a hope that just by putting it out there that will impact inflation expectations, and that might do the job for the Bank of England?
I don't think so. I think ultimately the hope is, what we all hope, that this conflict will be relatively short, and that the supply of oil and gas will not have as major a negative impact as we fear.
So a new forecast from Morgan Stanley seeing a 4% LNG supply shortfall in 2026 just on Qatar alone. Now, that doesn't sound too bad, 4%, right? I mean, yes, the marginal buyer will have big problems, but more buyers are turning to the US. Is there any possibility that even for Europe, the US could fill some of this shortfall?
Yes, I mean, we shouldn't forget that when we started the year, we thought that liquid natural gas would be in oversupply, that oil would be in oversupply. So we came in thinking there would be lower prices. So clearly some of the supply has been damaged, but it is manageable. There have been some releases of oil reserves in various parts of the world. It all depends what else gets damaged, and it does take a while. So this 3 to 4% might take 3 to 5 years to get back, because facilities need to be fixed.
Yeah, that's for sure. What is the number one question you're getting at W1M? What's the number one concern?
So ultimately, our clients, obviously no one knows. They wish to know what we are doing, how their money is invested. And generally, the way we invest money is that we invest in companies that have good pricing power. So clearly, when inflation is an issue, we want companies to be able to continue to thrive in that situation.
And, what's been a little bit surprising, I think, about this is that even, in the US here, benchmarks are not that far off where they were before this war. So you've seen massive moves in treasuries, massive moves in gilts, massive moves in global bond markets and oil markets. Would you stay invested in equities here?
I mean, I think that's a really good point, because I do think that what equity markets are telling us is that it's probably a manageable situation. The overall index masks big swings, right? Because certain companies have done okay and others have really plummeted. But overall, the equity market is not pricing in an Armageddon scenario.
No, and perhaps the worst of the danger has passed, or at least that's the hope this Friday. Tineke, thank you so much for joining us in studio. In particular, Tineke Fricke is head of UK equity research at W1M. Now to some corporate news. Bloomberg has learned Goldman Sachs and JP Morgan are among investment banks offering hedge fund clients ways to bet against the $1.8 trillion private credit market. We're told the firms have assembled baskets of listed companies with exposure to the space, which has been facing pressure from a wave of investor redemptions. Bloomberg understands that Unilever is in talks to sell its food business to McCormick, an American spices and seasonings maker. Sources say a deal could come together by the end of this month. It follows Bloomberg reporting earlier this week that Unilever was considering spinning off its food business. Alibaba shares slumping after it reported third-quarter sales that missed estimates. Sluggish growth in its core e-commerce business dragged on earnings, while intensified competition in food delivery also crimped profits. Alibaba's cloud and AI units saw the fastest growth. The company says it aims to quintuple revenue from those businesses in 5 years to $100 billion annually. The deadline for U.S. taxpayers to file their return is just weeks away, whether they live in New York, London or Paris. But accountants may find their work drying up this year as AI chatbots improve, close to the point of being able to navigate the U.S. tax system. Let's get more from Bloomberg's Charlie Wells. So, Charlie, that's quite the claim. The U.S. tax system is particularly complex, I would say. Are they really, these chatbots, able to work it all out?
People are starting to make inroads here. And what I would say is if you walk around Bank Station or Canary Wharf after market close today and say April 15th, a lot of these traders, a lot of these bankers who are U.S. people who have to file their taxes wherever they reside are going to look at you and tell you the only thing worse than paying my taxes is filing them. Because as you say, the system is really complex. There's a lot of different rules. And a lot of these really highly paid people pay accountants to help them prepare their taxes. Their accountants turn around and say, okay, here's all the stuff you need to get for me. And so these really busy people have to fill out their taxes, do a lot of this work. And so they're starting to use AI to help get a lot of these PDFs, get a lot of this information organized for their accountants. That's one of the use cases that I really came across in reporting this story.
And of course, we saw a huge sell-off in some of these names that prepare your taxes for you in recent weeks as that sell-off from AI started spreading. But surely it could be dangerous in this environment too.
So this is the question, right? So that SaaSpocalypse, this issue that maybe some of these big tax software companies, could be replaced by AI. And I think that some of these stories are use cases of using AI instead of, say, Intuit or H&R Block products. They control 80% of the U.S. tax software market. But as you say, there are risks here. And we spoke to over a dozen tax professionals, tax preparers, and they said that, look, just because you're using computer code, it doesn't mean that the tax code is going to overlay on that easily. A lot of these, AI LLMs, they hallucinate. They aren't up to date. So there have been major changes to the U.S. tax code over the past year, and some of these LLMs just aren't up to date yet.
Well, and the other thing is you don't want to raise red flags, right? So are you willing to have the AI do your work for you and chance that red flags might be raised and it wasn't even your intention? What are you hearing from people that have prepared their taxes this way?
This is another main concern, right? What is the recourse if one of these models gets something wrong, right? There's not a lot of history here. And as you say, the IRS is, razor focused on this issue because they know that this is out there right now and that people could be doing it. If you get audited, the last thing you want to say to a federal official is, oh, I just had AI do this, right? So accountants really are urging caution here. But again, I spoke with an accountant yesterday who said, oh, we use AI at my firm, and it's making my junior staffers more efficient. And so I think this is a nuanced story, right? It's something where this is helping professionals in the space. This is helping very busy professionals at bank or at Canary Wharf who don't want to spend their weekend downloading PDFs, downloading bank statements. So it can be helpful, but you have to know the limitations. I think that's the key that I picked up in talking to a lot of these people.
Charlie, have you filed your taxes?
No comment. No comment.
I am not going to ask you a second time. Bloomberg's Charlie Wells, and I would urge everyone to read the story. It is a fascinating and funny read. Plenty more coming up. This is Bloomberg.
The risks to the growth outlook are tilted to the downside, especially in the near term. The war in the Middle East is a downside risk to the euro area economy, adding to the volatile global policy environment. A prolonged war could increase energy prices further and for longer than currently expected.
The ECB President Christine Lagarde, and that is a sentiment that's been reflected across the central banks, and you can see it in this picture because this is how markets reacted. Pricing in 2 to 3 hikes now for the Bank of England and the ECB after those comments just this year, mind you, pricing out any hikes from the Federal Reserve and obviously cuts as well. We'll see how this progresses. It all depends on duration. Had a lot of ECB speak just this morning alone. One of the speakers, Thomas Nagal, saying that there actually might be a hike in April if things continue this way. Let's move on because we have also the idea that oil prices and these interest rate hikes might actually crimp growth, and that's being reflected in the swaps market. And then investor sentiment is also really troughing at this point, even though we haven't seen stocks come off a huge amount, but we're at levels last seen in May of 2025. So at least a year. All right, your risk events for today. At 7 a.m. we get UK public sector finances data. And then, of course, today is triple witching, so watch for that last hour of trading. It could be a lively one. At 5:30 p.m. we also get the ECB's Nagal speaking again, so we'll see what else he has to say after a day's trading. Coming up, an exclusive interview with the president of Cyprus. That's in about a half hour's time, so do stay tuned for that. The opening trade is up next. This is Bloomberg.